Welcome back to the channel. A lot to unpack this week. Going to do our monthly mortgage rate update. Going to talk about the different types of products, options available with the fixed variable options, the most popular products, what it means for Canadians that are renewing, maybe going out to purchase, or restructuring their mortgages as these mortgages come up for renewal. A lot of Canadians looking at their options right now, especially with interest rates being much more elevated than maybe where they started their journey just a few short years ago. So ultimately right now we're going to go through some of those different products, what it means for an insured, insurable, conventional mortgage, and what products apply to what individuals. So we welcome you back to the channel. It is Friday, Finance Fridays, and I'm your host, Anthony with InTouch Mortgage Solutions. And if you have not subscribed to the channel, we invite you to go ahead and do so. Don't forget to hit that notification bell so you get notified every time we post a new video. As well as don't forget to leave your thoughts, questions, and comments in the comments section below. And do us a favor, give the video a like. It does help the YouTube algorithm get this content out to as many Canadians as possible. So let's dive right into it. Ultimately, right now, this week, very quiet, not a lot of things happening. Ultimately, we are getting some data. Still a lot of headwinds when it comes to fixed rate mortgages in Canada. As you may be aware, ultimately, fixed rate mortgages here in Canada are determined mostly by the bond market. What's the other important thing to understand is that even when the Bank of Canada does decide to cut interest rates, it doesn't necessarily impact fixed rate mortgages. It could slightly impact them for a short period of time, but it all depends what's happening externally. So it's very important to understand when the Bank of Canada cuts, that directly impacts variable rate mortgages, those types of mortgages that are on an adjustable or fixed static payment type of variable. And that is a key component. Now we'll talk a little bit more about these products as we get into the interest rates, because I think it's important for viewers to understand. Sometimes when you're looking online, you're perusing potentially interest rates, you may see these very attractive rates, and ultimately they may or may not apply to you, so you have to understand the type of product. For example, the most publicized rate you'll see online is the insured rates. These are very, very low, but these are designed for purchases, right? If you're going out and buying a home, an insured purchase with less than 20% down, right? You're not putting a full 20%. The purchase price is going to be sub $1 million. The maximum amortization on that is going to be 25 years. You can go less, but the maximum is 25. And there are generally with insured mortgages, a default insurance premium that is tacked on to the back of the mortgage depending on the size of the down payment. Now that's an insured purchase. There's insurable purchases as well as switch transfers, which are very similar to an insured mortgage. The only major difference is that the actual buyer is not paying the default insurance premium. So that is basically covered by the lender because they're putting 20% or more down. But there are certain limitations as well. Your purchase price cannot be more than $1 million. It has to be sub $1 million. Maximum amortization has to be 25 years. And ultimately, if you are looking to switch or transfer from your existing mortgage, as long as the home was purchased for less than $1 million and your amortization is going to be less than 25 years, there are many different products available from many different lenders, especially these broker-friendly banks when it comes to switches and transfers. And a lot of time, a lot of these programs do cover sometimes the actual discharge from your existing lender, as well as the transfer cost and appraisals to switch over to a different lender. So these are definitely some really good components. And then there are obviously the conventional style of mortgages, which are generally for purchase or refinance. If you're looking for that 30-year amortization and you're looking for a mortgage or purchase price of over $1 million, you have to go conventional. No default insurance and premiums apply to conventional mortgages. And some lenders right now ultimately are being very aggressive on the rate, or they're offering a cash back incentive for these particular products. So depending on the size of the mortgage, you are eligible to get a cash back component. Sometimes it impacts the rate a little bit, but ultimately, if you're not a banking member with that particular bank, then you may be required to open an account with them and have those mortgage payments come out of that account in order to take advantage of the cashback option. Ultimately, speaking to a mortgage professional, weighing out those options, understanding those differences can help keep thousands of dollars in your pocket. And ultimately right now too, one major conversation as we get into these interest rates is the differences in these variable rate products. As this many clients are looking at variable rate right now, they are offering some pretty attractive rates, still significantly higher than some of those fixed rate products. But as many Canadians anticipate that the Bank of Canada will maybe cut in possibly July, we don't know, but in September where the projections are, that could lead your payments down a different trajectory. You could see your payments come down. It depends on if you're on an adjustable rate mortgage, where your payments will move automatically versus some of those static trigger rate mortgages that we heard so much about just not too long ago, where the payments did not actually change and a lot more money was going towards just basically covering the interest cost and then seeing those amortizations go up. So understanding some of the differences are very important because that will help keep a lot more money in your pocket and you'll better understand what it is that you're signing up for. So let's get into some of these fixed rate mortgages, these variable rate mortgages, the most popular products. These are some of the best rates that we've been able to achieve. Let's take a look at where they've been, where they've gone, and sort of where they are right now as we begin the month of July. So obviously the 5-year insured, that's the purchase. If you're looking at a 5-year insured, we were starting around 4.94 just in April. We're down to now around 4.64 right now. Ultimately, there is a little bit of a variance in the sense that we can get them a little bit lower. It just depends on those prepayment options. I think this is a big component to understand how much money is being put into the mortgage, how much money you're allowed to prepay annually or increase your payments by. And a lot of clients are very conscientious about these types of products and the lender. Now you have your 5-year insured variable rate mortgage. These have always been a little bit more heavy on the discount, gone from prime, which was back in April 7.20%, minus around 1%. You were looking around 6.2. You can see how that's progressively got a little bit better. And now for some insured mortgages, now the prime has went from 7.2 to 6.95. With most major banks, you're at around 1.2 as a discount. That gives you an interest rate around 5.75%. Now, when we look at the 5-year conventional fixed rate mortgage, ultimately, we've definitely seen a little bit of a movement there where we were pretty much in the mid 5s back in April, and we've seen that progressively get better. We've seen some lenders offering as low as 4.89 to 4.99% for a 5-year conventional fixed rate mortgage, which is pretty good for clients that are still looking at that 5-year product. Then you have a 5-year variable rate conventional. Back in April, not too much of a discount. Now we're starting to notice a lot more of the lenders come back on board, offering some good discounts. We've seen prime minus 105 to 1.10, so basically a rate of around 5.9% for these particular products. Now it's important to also note with the variable rate mortgages with a traditional bank, they are going to be offering you a 3-month penalty. That means if you decide to break that mortgage in that 5-year contract, they're all closed mortgages. These variable rate products do allow you a 3-month penalty to exit. And with variable rate mortgages, you're eligible to lock in for the duration, the remaining term of your mortgage. So that is also a benefit to having the variable if you're thinking about that option in the Bank of Canada where things are headed. Then we go into the 3-year insured. The 3-year products have been very popular over the last little while because it's that sort of middle ground between, taking a higher, more expensive 1 year versus a longer 5 year, especially if you're thinking that interest rates are going to come down. That 3 year has been pretty popular. Starting, the 3-year insured around 5.79 back in April. Now we're all the way down to around 5.99. Some a little bit higher, some a little bit lower, depending on the lender, the product. If there's a cashback, all depends on those particular products, but we have been seeing around 4.99. Then you have your 3-year conventional mortgage. That's, ultimately where a lot of Canadians are refinancing into a 3-year. Maybe they're looking at restructuring, paying out some of these debts that they've incurred, or maybe they're just looking at, switching over. Their purchase prices were well over $1 million, and they don't fit into some of these insurable products. We're starting around 5.6, 5.8. And then we're all the way down to around 5.04 to 5.14. That's generally the range that we're seeing right now. We've seen as low as 504, but as high as 514 with certain lenders. And that ultimately has a lot to do with the type of lender, the product that you're looking at. Remember, if you're going with a lender that wants or has a line of credit, you want a line of credit, if you don't want a line of credit, looking at the exit strategies, looking at the long-term picture of that mortgage. A lot of first-time home buyers generally, want to sort of work with a standard mortgage, not a collateral, and we can talk about that more in another episode. But then another popular product that's been coming on board is the 6-month insured product. This is obviously for an insured purchase or a switch transfer. This is literally where you're buying in 6 months, right? You're basically going in for 6 months, hoping that interest rates will change, but you have to meet certain criteria. There are obviously renewal options with this product. They were pretty expensive back in April. They've come down to around 4.34 and change right now, a little bit less for some of these products, especially if you're looking at that short-term duration. So these are obviously some of the best products, some of the best rates. Obviously there's different rates for, 1, 2 year, still relatively high. You're tickling that 6% mark for the 1, maybe just under 6% for 2. And then obviously 4 and 5 are very aggressive. A lot of times what we'll tell clients is going through the options, looking at those options and solutions. If you're looking to find out or compare some of these products, in the description box below, there is a link to our app. You can download the app for free, play around with some of these calculators that are in there. It does help if you're looking to purchase. It does give you all the tools, land transfer tax calculators, refinance calculators, ultimately compare side by side different products, different prepayment options. If you have a mortgage and you want to find out, hey, if I did a prepayment on the mortgage of this amount, how much would my mortgage change? How much is interest? How much is principal? Feel free to download it. It is a great tool. But ultimately right now, these are where some of the mortgage rates are situated. We're definitely, as I said at the beginning of the video, we're seeing some headwinds right now, but we do anticipate as global inflationary pressures sort of pull back, we see a lot of these central banks sort of contemplating these cuts at some point throughout the course of the year in 2024 or 2025. When that happens, this could obviously move the needle for the bond market here in Canada, hopefully driving down some of these fixed rate mortgages. But right now, if you're approaching mortgage renewal in the next little while, let's say 3 to 6 months from now, you do want to reach out to your lender or your broker to start the process to get you into some of these better rates, potentially locking in a better rate for the time being in the event that fixed rate mortgages end up spiking again. If a cataclysmic event happens, it pushes bond yields up and higher. You don't want to miss that opportunity. So as long as you're within that 120-day window, start talking to your professional, your mortgage advisor. So you do want to talk to your mortgage broker, your lender, to find out more options available to you and what product may best suit your situation. If you're buying, refinancing, restructuring, and ultimately, if there is an option for you. Now, let us know in the comment sections below what options you would be taking. Let us know in the comment section below what you think is going to happen as we approach July 24th. Obviously, that is the next Bank of Canada meeting. We'll be talking a little bit more about some of those data points next week, so make sure you're subscribed to the channel. And we wish you all the best. We wish you a great Friday and an even better weekend ahead. We'll see you next week.